How did the loan on that work? When he took the 250 out and then he put it back in within 3 months, how did the loan work?
How did it work?
Yeah.
Just in terms of the process?
The interest, and people are always talking about how does the loan rate work if you do take out, like Billy took out 250,000, he put it back in 3 months later.
Yeah, every carrier is different in terms of how they apply interest. The rates are usually different, and it's also direct versus non-direct recognition based on the company, so that they operate differently. So this is a direct recognition company, so that means they recognize the loan. So the interest rate in terms of the loan versus the dividend that's being applied varies based on if there's a loan versus not a loan. So in other words, if you don't take a loan, you get the full dividend crediting. If you take a loan, the portion that's loaned has a slightly lower dividend rate on the borrowed money versus the money you haven't exercised or touched. So that what's left remains in the standard dividend structure. The loaned amount gets a lower dividend rate because you have borrowed money against it. But at the same time, you're still earning on it. You're still not losing on the value of the cash because you've borrowed against it. It's just a slight reduction. But because of your own banking system, the money, so the way this particular carrier works, you're receiving a accrued interest similar to a credit card. So any money that comes out is accrued daily based on outstanding loan balance. So that accrues over a day, just like a credit card does. Each day there's an accrued interest. You get that statement at the end of the month on a credit card. It shows what that interest amount is for the financed amount that you've borrowed. This operates the same way. So if you're making payments back to yourself over time, then you're just replenishing the principal that you've borrowed plus the interest. So it's reducing that interest that's borrowed against. It's reducing the overall interest that's owed. So this money is being taken in and out. So this gentleman took $250,000 out of his policy, and within 3 months, he paid it all back. So now all he did was finance his business with, in essence, a business line of credit. And now he's exercised that to improve whatever he was doing from a business perspective. And he's funneled it right back in. It was just basically a short-term loan. But instead of going to the bank, paying the bank the interest, paying the bank the principal, losing the opportunity on the growth of that money going forward, because once that dollar is spent in terms of that payment, you never recover and gain it back again. Versus using your own short-term loan scenario like he just did, his business line of credit, which was his policy, he pays himself back. He doesn't lose any earning power on that money. It's continued to grow because you've borrowed from the carrier, not from your policy. It's a loan. So the money continues to grow inside the contract. He acquires the dividend and then pays himself back with the interest and principal and gets to regurgitate it and use it again another time. So he's continued to do this multiple times with his business, each time generating more and more loan because he's generating a bigger and bigger business model for himself. So he's slowly, steady increased his output for his business based on employees, based on equipment, based on buildings, you name it, anything that has an expense to it. He's been able to use this short-term loan scenario out of his own policy to exercise and throw back into his business that's making money. He's making money, obviously, through the business, but he's making money on his policy simultaneously. And then he pays himself back and never interrupts his profitability within the business. So it's a $1 becoming $2, but obviously on a much bigger scale than just $1 to $2 ratio. But that's the concept. So he's just literally just taking money out, washing it within the business, putting it back into his policy, but exercising that to an output that is an advantage to him in the business to grow his business further, and then puts it back in because he's not losing that earning power within the policy and is getting that growth factor that's happening all the time, regardless if he takes money in or out. But he's utilizing his own banking concept versus having to go to a financial institution, get a loan, pay the interest, pay the principal, never get the earning power on that ever again. That's the lost opportunity cost going forward, which becomes astronomical in your lifetime of how much money we're spending to pay someone else the liability versus paying ourselves our own liability back.
So essentially the loan isn't complicated because pretty much instead of the interest, you're always going to pay. Like you said,
regardless.
$1 is always working in two different areas. We just don't use that concept for ourselves. We've just been brainwashed to use the bank for that. So if you take $1 out or the bank gives you $1, you're going to pay the interest back no matter what. And you don't never recognize the interest because you always just have to pay it. There's no choice. You've got to pay it. So the same thing with his policy, he has to pay it back. So essentially he doesn't even notice the interest on the 250,000.
And the other part of this, just real quick, because he's using it from a business perspective, any interest that accrues on that loan is potentially a tax deduction on the corporation. Now, in a short-term fix like this, you're not talking about a huge amount of money, but the point is you're reducing the expense of that money even further because you have that capability of potentially writing off a small amount of interest that's accrued over that time that you pay it back. So all this is doing is just recycling the same dollars, but at the same time earning on both arenas. That's what people have to understand, is by doing it this way, you're earning in two arenas. You're earning on your policy, and in this example, he's earning through his business with profitability of jobs that he's getting. So he's making one become $2 versus just letting one sit there and accrue and accumulate and collect dust and hope it has this achievement of a greater return at the end. He's making two things happen from one and is making himself much more profitable in terms of assets, because he's making his business profitable and he's making his personal side profitable, but using the personal side to leverage the business, which is just a fantastic way of doing things. When we talk about becoming your own bank, this is the true situation. And he doesn't have to just use it for his business. He can use it for himself, just like we've talked about, for his own personal vehicles, not just business vehicles, education for his kids that he has, and then supplement potentially future weddings or future retirement supplement as tax-free. This always is tax-free, and there's no limitation, that 59.5 rule like you have in 401ks, TSPs, 403bs, 457 deferred comp plans. All those have those regulations because you're going to be penalized and taxed. This avoids all of that and just makes sure that you're constantly just rotating your cash. It's that what I call money in motion. That's what he's doing. He's moving money at all times and making something happen, not hoping that's going to happen based on a rate of return.
Well, and he became his own lender. So what you're describing is exactly what everybody doesn't think about when we say become your own bank. When we say become your own bank, it also means become your own lender. And becoming your own lender means that if you go to the bank and borrow money, if Billy went to the bank and borrowed the 250,000, they've taken 250,000 and turned it into the second dollar. So they're giving you what they're utilizing, what is the aftermath of this process. So
they do it already. We're not taught to do the same as the bank.
They've already split the 250.
Correct.
So they split the 250 and gave you the back half of it. Therefore, you can't split it again. And you owe them the interest back. But when you're the lender, you can now run this entire process by yourself. So you can lend the money to yourself and become the bank. And then on the back end, like you said, if you're using this for business, then now you actually have the ability to write off the interest. So you get rewarded for being the lender and get the tax breaks that come with having the lender status.